Tuesday, the 4th, I think it's the 14th. 15th of August.
Yeah,
I can't believe it. 1 o'clock on the East Coast. Market Call. Guy Adami, Dan Nathan. In a minute, the great Carter Worth of Worth Charting will be joining us. Today's Market Call brought to you by CME Group, where risk meets opportunity. Of course, FactSet is our data provider, financial data and analytics, powered by Tomorrow. Today, Dan, the market's being powered by not the U.S., but by all things China, which we'll talk about. Yeah. But how are you today?
I'm doing well. You know, it's interesting. We spent some time yesterday on our On the Tape podcast that we do on Monday, usually with EY from SoFi.
On vacation.
She is on vacation. She deserves a vacation. Just, I got 2 emails about her last night from a viewer, from a listener, just giving her compliments, by the way.
Were they upset that she wasn't with us?
I think a little bit. I think you and I can be a bit insufferable together one-on-one here. But, it's interesting. We spent a lot of time talking about China. It seemed like over the weekend, there were a whole host of stories things that we have been tracking. We're trying to be very careful, not trying to sound like sort of doomsayers. And I think part of the thing with China is that some of the loudest voices about China, whether it was this debt bubble that's buried, whatever it was in commercial real estate land or whatever the heck it is, it's like they've been talking about the same thing for 10 years, right? And so we're cognizant of that. But sometimes if you go back and look at the history of the markets, and you have aptly brought this up, not last week, but multiple weeks ago, the summer of 2015, in August, some similar sort of concerns were happening, and the S&P 500 woke up all of a sudden from its summer slumber and dropped 10% in a straight line in a matter of days.
Pretty much. And, we're not saying necessarily we're on the precipice of something like that, but history is absolutely repeating itself 8 years later, almost to the day. It's interesting. That was a yuan deval out of China, but now it's just doing it sort of on its own. But not really, because the Chinese are trying to add liquidity to the system. And what happens when you do that? Things start to go haywire, and it's manifesting itself in their currency. But it's not just China. We'll talk about Japan as well. But let's look at the headlines real quick, because everybody's talking about it all of a sudden. People start to pick up on these themes. We're not haters. We're just trying to sort of at least connect the dots with what's going on in the world. And right now, to me, the epicenter of everything is global bond markets. And then if you want to get granular, some of the things that are going on in China. And here are the headlines that we just pulled, 4 of them, if you want to take a look at it.
Let's go back to the Bloomberg one, because I think this is kind of interesting. And again, these are things that we've been kind of pointing out, if you will, but going back to that 2015, 2016 period, because it kept on going, there were credit issues, there were growth issues, there was issues about their currency floating, and it seems to be all the similar sorts of things. Now, the question, and this is maybe something that we'll hit with Danny Moses when we record our On the Tape podcast
Thursdays,
on Thursday. And we actually have Peter Bookvar on with us this week, and he's the perfect guy. He's on Fast Money with us today at 5 o'clock, and he's going to give us a little preview of this longer conversation we're going to have. But look at all these sorts of things. Let's go to Peter's note this morning, Guy, because Peter's been talking about this sort of stuff for a while. Not a doomsayer. I call you Nostradamus every once in a while. But again, we're not fortune tellers. That's why we're kind of picking up on this stuff on a daily basis. Look at this. What do you take out of this comment from Peter in his note this morning? And again, this is not some Johnny come lately to this. This is something that he tracks kind of
he's
closely.
Pointing out, obviously, the level in yuan and other things that we've been talking about. And he's right to point it out. He's also been pointing to global bond markets and the volatility that we're seeing, and sort of, I don't want to say the undoing, because that might be too, but there's clearly some things happening in the global bond markets. It's happening here in the United States with our 10-year yield pushing up against the levels we saw back in October. It's happening in Europe. It's clearly happening in Japan. And to a certain extent, you're going to start seeing similar things happening in China. So he's right to point it out. And again, you can't have it both ways. When things are going well in China, you can't use that as sort of a pillar of your bull case for the U.S. equity market, then say it doesn't matter on the flip side when things are not going particularly well. And things are not going particularly well. And the fact now the Chinese are not going to report their youth unemployment number. I mean, you ask yourself, what do you think's going on there? And then put up that prior slide real quick, because think about what Taiwan is saying. I mean, I'm paraphrasing. Taiwan's election is all about war. They are preparing for it. Clearly, the Chinese are preparing for it. The only people that clearly are not preparing for it are market participants here in the United States.
Yeah, with the 16 VIX, it seems kind of complacent. It's interesting. This one headline about the China youth unemployment, and we were talking about it last week at 21% or something. Isn't everything that we hear about China is that they have this huge demographic problem? So you would think that they're saying they have too few youths, right? Like, so I don't understand how they have so few jobs
and they can't get jobs. Right.
I don't like that. That's not something that I like is easily
reconciled or explained. I mean, they have an economy that's probably 50 years behind the curve. They're trying to obviously getting into the 21st century, but they're woefully unprepared because of demographics and because of some other things. And to a certain extent, I used it before. I mean, things are starting to unravel a little bit now. I think you're going to start to see hints of that in terms of the VIX here. You mentioned it up today. We'll see. But with each passing day, this is not going to rectify itself. And President Biden said a couple weeks ago, one of his concerns amongst many, a wounded China is liable to do things that don't necessarily make sense. To me, that means they may do something with Taiwan.
Yeah. All right.
And I've been saying, listen, I mean, we're not just pulling that out of thin air. We're not hoping for it. But that's out there.
Well, it's funny. I remember in late 2021, when there was fears of a Russian invasion of Ukraine, it was kind of telegraphed. A lot of folks, a lot of political scientists, a lot of pundits were saying it's not going to happen, right? It's just not something. And so I remember we had Ian Bremer of the Eurasia Group on the Tape podcast in December, and you were like, "This is happening." And I remember you being very definitive about that, and we tried to think about, well, what are some of the knock-on effects? This was at a time when the Fed was just starting to come to grips with what they had missed about inflation, right? Now, ironically, Guy, is that we had that spike in crude oil. We had that spike in nat gas when tanks started rolling into Ukraine, but that was kind of it after a month or two. Now, you know what I mean? So like, it's kind of, and a lot of folks, I think, really overdid the permanent implications of that, also with foodstuffs. And maybe because the war is drawn on for so long, maybe we'll start to see that. You've been talking about a reemergence a little bit in some of those inflationary pressures, but again, the way that if something happened with Taiwan, whether it starts with the blockade or it starts with something economic in nature, it's not likely to go to the way that we think it's going to go.
No, never does. And to your point, obviously, Russia, Ukraine, the effect. I want to be clear here. We're not talking about what the humanitarian aspect of it is. We're talking about the market implications. I mean, what happened in the commodities market and the crude oil market lasted maybe a month and a half, 2 months max, and then things started to normalize. But look what's happening with the Russian ruble. I mean, it's at levels we haven't seen since the war started. So that's reversing on itself. That's not particularly encouraging. And of course, the difference being Russia is a fly in the ass of the Chinese economy. And obviously, the importance of Taiwan to what goes on here in the United States cannot be understated at all. So it's different in so much as if something were to happen between China and Taiwan, it could be worse. And that's not me talking about. There are other people that have been out there saying very similar things.
All right, before we get to Carter, I just want to pull up that one slide from Axios, and I thought this was really interesting about strongmen not being great at managing economies. And when you think about this, and one of the things that I think a lot of folks here in the U.S. were opposed to our aid of Ukraine here is they feel like we are pushing Russia into the arms of China and giving China, the ability to kind of benefit, or at least from this kind of, I guess, isolation that Russia has faced on the world stage. And the combination of those two countries, supporting each other in these endeavors, especially with the potential for something with Taiwan, is not a great thing. I see that. But I think, again, what we learned from the pandemic is that our reliance on China for our supply chains and for tech and chips and the like is not a good thing. And what Europe has figured out in a very harsh way is that their reliance on Russia. So for a whole host of reasons, our support for Ukraine, and again, this is my opinion, has to do very much with our national security.
It's going to be interesting, right? Because 100%. And it's clear that U.S. companies are trying to move away from their ties to China in terms of supply chains and production and all those things. The problem, of course, is it doesn't happen overnight.
It's been going for 30 years. 40 years.
There's going to be a window where if something were to happen, these companies would be hamstrung by it without question. Now, 5 years from now, we're having a much different conversation, and maybe nobody will care about Taiwan at that point. But in the here and now, I think it's extraordinarily important.
Yeah, and I guess the last point for U.S. multinationals is kind of the precedent that was set as far as pulling out of Russia when they invaded Ukraine. I mean, that was something that I think at the time, and we saw major U.S. brands like Starbucks and McDonald's and the like here. So it'll be interesting to see what happens there. And hopefully, you mentioned the humanitarian side, and you were always, I think, very adept at pointing this out. Is like, yeah, we're charged with looking at this stuff through the lens of the markets in economics, but we don't want to underscore the fact that that would be a humanitarian disaster. All right, let's bring Carter Braxton Worth of Worth Charting in for us. Carter, how you doing, bud?
Man, I'm good. I'm good. You guys look great, the studio, and it's all very crisp.
It's pro, as the kids say, right?
Crisp with good lines, great colors. The white shirts, the blue background.
We're digging your kitchen.
I love it.
Okay, like as far as I'm concerned,
I mean, the whole thing is working. I'm just waiting for something like a dog or something to appear from that dining room.
That would be so 2021. Carter's got this all dialed. All right, Carter, we want to do a few things with you really quickly, and we appreciate you being here with us on a Tuesday. We want to take a look at Chinese equity markets, and we know that let's just pull up the Shanghai Composite. We have a chart of our own that we made here, and I just think it's interesting. When we want to look at your charts on the FXI, the iShares large cap ETF that tracks the Chinese market, very heavy into tech names and internet names in particular. But let's look at the Shanghai Composite right here, because this one is interesting to me, Carter, because I think probably a lot of global investors are more focused on this than the FXI. I think that's something, it's a U.S. trading instrument for all intents and purposes. What does this Shanghai chart say to you? It's a pretty quick drop over the last few weeks or so. We know that the intervention that we saw over the weekend here, and again, a lot of us got conditioned when we saw countries coming in and easing. The knee-jerk reaction is to buy equities, right? But that wasn't the case here as it relates to the Shanghai.
Sure. I mean, if you think about just the sort of the sequencing, right? I mean, it basically makes a low around the same time as the S&P and global equities. And it struggles since May, whereas obviously the U.S. is going on to make new intermediate highs. There's not a whole lot of authority to this level. The green line, the horizontal green line notwithstanding, it's really what a pair of twos is, right? I mean, this is sort of neither here nor there on the short term. Long term, and we'll look at some of those later, I do think it continues to be a developing bottom. But here at the 3150 plus minus level, pair of twos.
It is fascinating to watch. I mean, it's somewhat counterintuitive. Dan brought it up that historically you see obviously the knee-jerk reaction being buy everything, and let the chips fall where they may. Something's changed, but you brought a series of FXI charts that may suggest maybe for one day or so that worked, but in long term, I think you're starting to like what you're seeing here. Obviously, FXI, I think it's heavy Alibaba, Tencent, Baidu, probably a handful of other names that will come to me in a minute, but let's walk through this FXI charting, Carter.
Right. So, it's severe weakness, right? You're talking about 55 to 22, an extreme sell-off that basically starts before the sell-off in the U.S., although it bottoms at the same time in the October-November period of 2022. But let's annotate it and see what we can do. So the first iteration, calling into effect or citing the COVID low. So obviously it undercuts the COVID low in a big way and recovers to it several times and hits its head at that level. And that remains a pretty important reference point. Now, if we put in the downtrend line instead of this line, let's toggle, let's do those back and forth. There's a reference point here. And so if we look at the downtrend line, and now let's put in an arrow. The arrow is a judgment, of course. That's one could say, okay, so what? You drew an arrow. Who cares? That's your opinion. But I think the next chart will show why this is in the process of bottoming out as formations go. And if we put them all together, I think ultimately we will yet again make it back into the sort of mid 30s as opposed to where we are, which in the high 20s. So at the end of the day, I would say it's asymmetrical. If it's wrong being long here, it's probably more of a small wrong, a waste of time. If it's right, we can catch a pop. But the alternative is if it's big wrong and that this is going back to those lows, well, then global equities are going much lower, et cetera, and so forth.
So let me ask you a quick question, Carter, because a lot of this, you had a bullish, and I'm looking at some questions in the chat. You were obviously bullish on Alibaba. That was extraordinary because that stock went from 90 to 103. it's round trip. So in some ways, is this just sort of a reaffirmation of that Alibaba call?
Well, remember, Baba popped most recently on its earnings has given it all back and then some. So it's below where it was when it had a news-related jump, pop, or advance. You can see it there just 3-4 days ago, the pop and now below. But if we were to look at a longer-term Baba chart, maybe longer term the way we just looked at FXI or HSI, you'll see, of course, that this is also. So the trick here is you have to, well, you don't have to do anything, but one should, if you can say that word, remove all that one knows. If you didn't know this was Baba, it was just a black screen with those blue bars, and it could be a software stock, a casino stock, it could be an ETF, it doesn't matter what. Is this something that had a great run up? Yes. Is it something that gave back the entire move, a collapse? Yes. And is it something that looks to be starting to stop going down, curing, healing? Yes. And so all of those three things I said are incontestable. Nobody's opinion, those are the facts. Great run up, great collapse, now basing and bottoming. But is it going to make a new low? That's the asymmetrical part. I think if we're wrong, it just muddles, gets stuck, doesn't really get better. But if we're right, we get a nice pop. Because the alternative is that this is going to make yet a new low. That would be starting to get into all-time lows for Baba, which means that China has got substantial downside, which means global equities and global economy are basically got a lot of downside. And while that's possible, that's not today's lunch.
Yeah, and so it's interesting because again, sometimes Carter, you've mentioned this on many occasions on Market Call that you're just looking at the charts and you're doing the work that you do, and sometimes we got to get tripped up by all the things that we think we know or the things that we interpret from the news flow, and so sometimes it's as simple as the way you lay it out, and it's a lot of pattern recognition and you have your process. So we appreciate that because again, sometimes it's one of those things that might help you by thinking about the technicals and looking at some of the divergences of why some of the news flow and the sentiment might be shifting in a way that doesn't make a whole heck of a lot of sense when you're in that moment. So I appreciate that. Guy just said this, Carter, a little bit before, really for him, a lot of this comes down to the bond market and yields. And, we just want to pull up this 10-year yield here because this is one that I've been on the other side of. I've been kind of picking at least through calls, the TLT. I've talked about it over the last few weeks and I've been wrong. Look at the 10-year yield here. It got right back up towards those kind of 2022 highs a little bit. And if you look at how far it's come, from the lows in the start of 2022, what do you think here? We have that 150-day. It's down there, I think, at like 370 or something like that. If we look at the CME, the Fed funds tracker here, we're looking out to the September meeting. There's no meeting in August. We know that we have the Fed Jackson Hole Summit later this month. But they're not expected to by any means to raise interest rates again at that September meeting. What are your thoughts on yield here? Is this a constructive looking pattern or is this something you want to fade at those prior highs?
Right. I mean, one has to, I suppose, as I say, thank you for choosing a side, right? There's no buts on however. On the other hand, that's all nonsense. You have to have a view and you go with it. And if you're right, you profit. And if you're wrong, you take measures and you lose, but you control the loss. I remain in the camp that rates are basically peaking, have peaked, and that we know the dollar peaked in September 2020. 1 month later, rates peaked. That's the bottom for now in equities. And the issue is, consensus is that we, quote, break out, whether they're coming to that judgment based on the fundamentals, the Fed or otherwise, or whether they're basing it on oil moving up, or whether they're basing it on the chart. There's an overwhelming view that we are going to break out. And we'll note, of course, and and everyone knows that real 10-year yields did make a slight new high just in the last 2 days. But it all feels as though it doesn't have enough oomph to really sort of stretch higher in a big way, which is to say, I think that doesn't make the new high and ultimately starts working lower, or makes a slight new high that isn't meaningful and then works lower, captures 90% of the odds. Because I think it's a small percentage odds that we make meaningful new high in yields.
It's interesting. So you look at this, Carter, and it was Bill Ackman a couple of weeks ago, and you and I were on the show together, and it was the day that he announced he was betting against the bond market. He thought yields were going higher. He top ticked it, if you recall, in terms of literally that was the day that we top ticked in the 10-year, and we went from I think 422 that day. I think we got as low as 386 recently, or 3-ish, and now we're right back. So we'll see. Again,
right. And interestingly, on the tape, I remember that day, and Bill Gross was out,
right,
saying that he's saying this is the buying opportunity of a lifetime. And look, you're only as good as your last trade. And is Ackerman better, whatever that word's in quote, than Bill Gross? Is Bill Gross better? I mean, it's not about that. We all are trying to make a buck. I mean, otherwise there's no point to this. There's nothing noble about Wall Street and about speculating. It's for making money. There's nothing noble about investment banking. It's for making fees. So the question is, what is the right play here to make some money? And I think consensus is overwhelmingly playing for higher yields. My hunch is it feels a little crowded, just as at oil at 65. Oh my gosh, recession, oil's going to 45. What happens? We just jumped to almost 90. Now everyone's looking for oil going higher. It's sometimes right to be consensus, but once you have an extreme move, sticking with consensus is usually wrong.
Mm-hmm. And that's why I wanted to bring it up, because here we are. So we're right back. So now it's the make or break time for, if you're a bond bear today or tomorrow, or the days where this thing needs to break. In other words, TLT needs to break down probably below 91.5, 92, or conversely, 10-year yields need to close above, 4.25, 426 or so. So keep that in mind. Personally, if yields do start going markedly higher, that's not going to be positive for equities in any way, shape, or form, which leads us to the next question from, I think, Earl. There's a very tight pennant forming in the HYG. How do we break out of it? So I don't know if we can pull an HYG chart up or not. I'm looking at what you're looking at, and you're right. I mean, there's an uptrend in place effectively from October. There's a down place in place, I guess, from February-ish, and you can see those lines will basically intersect about where we are now, this 75 level. I happen to think, Carter, if I'm right about what's going on, we break to the downside, because I do think there's a credit event. But Dan, that's what makes markets. I mean, those are the decisions you have to make. And in some ways, you don't have to make the decision until the pennant breaking one way or another does it for you.
Well, it's interesting. And I think what Carter's going to focus on next might actually prove to be the tiebreaker for this, what you would say is a pair of twos in the HYG. I'm guessing, Carter, right?
Yeah. I mean, it's a stand-up. You could feel the tension, but you can feel that it's equilibrium, right? There's an even matching of every dollar that's coming in and buying this thing. There's another that's selling it, and neither is in the ascendancy. And when there's more sellers than buyers, you go down. There's more obvious, and so at this point they're matched off. But equilibrium exists, but it cannot persist. And so we're about the end of the runway, which is the point of drawing lines. When you draw a pennant, you draw converging trend lines. You know, it's like the end of the runway. You know what happens when you get to the end of the runway? You either take off or you hit the damn wall.
Yeah. So well, it's funny. So again, I want to talk about the banks here, because I know you brought some charts in the XLF, the ETF that tracks the major money centers, but also obviously Berkshire. You want to focus on that one too a little bit. Our friend Doug Cass over at Seabreeze, I mean, he's forgotten more about bank stocks than I'll ever know. He's been calling them, and he was long them. I think he bought them well, either early this year, at some maybe in the hole during the regional banking crisis or so. And now he thinks they're kind of value traps here. And so I think the direction of the banks might be the tell on where the high yield credit market goes. If you think about all the things that we've talked about in this show so far, about issues in China with credit, global financial banks that might have exposure, if their economy is weak, what are the knock-on effects, right, that we might feel in other parts of the world? And again, it brings you back to financials in a surging rate environment, or where rates are likely to be higher for longer. So Carter, talk to us a little bit about what you're seeing in the XLF, because on a day like today, when I see the S&P down 90 basis points, but I see the largest bank on the planet, JP Morgan, down 2.25%, and it's come off its recent highs in a meaningful way, and it's approaching, to me, what I think is, maybe an interesting support level a bit lower, which was that breakout level from a month and a half ago. It tells me that we're getting to a point, maybe a possible technical inflection point in this sector.
Yeah, I mean, JP Morgan the dip that's underway is likely to continue, and down to the tops from which it broke out. I would say that's almost a lock. The real question is, does it find support there, or does it sink further into support? But either way, buy, sell, hold JP Morgan. I'm a seller here.
It's interesting. Jason Shapiro's got a comment. Clearly, he's trying to be a wise guy, but that's fine. So HYG breaks to the downside, but 10-year rates going lower. WTF? I assume that means what the fuck. So here you go, Jason. I didn't say that. I don't think Carter said that, but I'll play your reindeer games because I'm in that kind of mood today. there's a chance that the HYG could absolutely break to the downside, and yields could go lower as people find bonds a flight to quality. So if the HYG goes lower, which I think it will, means the market's probably going to go lower. So you actually could see yields go lower in a flight to quality in U.S. bonds. So weird things do happen. But Jason, thanks for playing our home game. I appreciate that.
So let me we got to answer that. Hold on. The HYG saying HYG can't go lower if rates go lower.
I think his point was if HYG is going lower, bonds yields going lower as well doesn't make a lot of sense. But that's
hold on. Just so the low point of the last 2 years, 5 years, 10 years in HYG was what? The COVID low. And where were rates then? They were almost zero. It's a nonsensical statement, whoever made it.
All right.
Let's move on.
Thanks for, as Guy said, thanks for playing. Let's look at the XLF because you said, okay, the JP Morgan is obviously the second largest component in that ETF that tracks the major money center banks here. Let's see what you're thinking here, because I think your charts are fairly definitive. I mean, when you think about just the levels in which they got to, they got Q2 earnings off to a very good start in middle of July. It gave a nice kind of I don't know, I think a tailwind at least to what was maybe some bearish sentiment heading into that period here. And it seems like, a lot of the enthusiasm, the bloom has come off the rose a little bit here, Carter.
Yeah, I mean, look, we're going to look at least the charts that I thought we could look at are a great, strong financial, the biggest one in this at Berkshire Hathaway, and then one that's pulled up lame today, Discover. But before looking at that, I think it's important to sort of put in context financials. We know the financials are the third largest sector in the market right now at about 12.5% weight, but in many ways they're the most important, right? The banks, the transmission mechanism for the economy, and their importance far exceeds software company X, Y, or Z, right? Or trucking company X, Y, Z. And so it's important to note that financials generally are a very, not only cyclical business, but risk embracing, and therefore boom and bust. We know that Morgan Stanley, not in this chart, but is right now trading where it was in the year 2000. It's 2023. This is one of the great financials of all time. If you have made no progress in 23 years, it means you're basically down 30-40% adjusted for inflation over 23 years. It could not be a worse investment. But what I wanted to start with is this two-panel chart. Let's go back to it. This is the all data chart for the S&P financial sector on the top, and then it's the relative performance on the bottom. We're at the 2009 financial crisis low, which is to say, WTF. Didn't we just get a WTF from somebody? I mean, the point is financials are almost never a good bet. Morgan Stanley is unchanged for 23 years. It's a highly cyclical, risk-embracing, boom-bust, leveraged business, and it's prone to screw-ups. Anyway, financials just don't like them. But let's look at maybe two. Let's look at the XLF itself. So here's the XLF since 2020. Let's put in some lines. Those lines kind of draw themselves. Let's put in some arrows. And let's put in the down arrow. I think we go to the lower band. If we pull this back to 2020, the COVID low, we're in the apex, and that failure recently at the top, now heading lower. I think you want to be short XLF, not long.
Yeah, I agree with that. And if you listen, Fitch, say what you want. I mean, we can talk about Fitch all day. They're late to the dance. Doesn't mean they're wrong, number one. And number two, if you look what's going on, again, global currency markets, global bond markets, I'm telling you, and Danny Moses was talking about this before, somebody's about to blow up, and it's going to manifest itself somehow, I think, in the banking sector, and we'll see. So I've long thought since March, April that Silicon Valley Bank, First Republic, that was going to be the first of many. It turns out there have been a couple smaller things along the way, but just given the moves we're seeing, it would be virtually impossible not to have some sort of blow up, given the magnitude of the moves we're seeing in both currency and bond markets, Dan.
Yeah, no, and again, it's funny. We've tried to be a bit patient with this because like the thought that could be so neatly wrapped up in a handful of banks that went under and then were pushed into the hands of stronger banks, and then the Fed and the Treasury just backstopped deposits and did all this stuff. We pointed out last night, Carter, on Fast Money, that Schwab is filling in its gap from earnings. I thought that was interesting. The KRE is rolling over a little little bit. You just did what you did with the XLF, but I think this next chart is pretty fascinating because it is the big kahuna. It encapsulates a lots of things as it relates to sentiment about markets, as it relates to financials, insurance companies, consumer companies, the whole lot. And it's Berkshire Hathaway. And I got to tell you, Guy and I spent some time talking about the SMH, the ETF that tracks the semiconductor index, which I also think is probably the next important thing, okay, going on in this market here. This chart on a 5-year basis, they look very similar, Berkshire to SMH here. And what am I seeing? Because, Guy, there's something, I don't know, man. You don't even have to draw any lines.
Doesn't draw. The lines draw themselves.
Yeah,
I mean, Carter, this, to me, if this continues, this is a textbook double top. And, we spent the last year and a half basically rallying off those lows, but we basically got ourselves just to the prior. I think that's a prior all-time high that we saw early in 2022. Now, I'm not suggesting how Berkshire goes, the broader market's going to go, but clearly a huge component of the XLF.
Right. So without putting any lines in, we know that it is the market in many ways. Does it have a peak in Q1 of 2020? Yes. Does it drop during COVID? Yes. Does it bottom on the same day as the market? Yes. Does it top on the last days of 2021, early 22, like the S&P? Yes. Does it bottom in October? I mean, the market has the same trajectory, it's just different. But this one's made it. And so let's draw the lines. We know that you have these well-defined. And so the question is, does it falter here and turn down? I put a red arrow in. You'll see it in the next iteration. I think so. We can annotate the double top as follows. The point is that even if it ultimately makes a new high, before you can exceed a former high, you typically contend with it. And so it's backing and filling on schedule, and contending is backing and filling or backing away. The red arrow is my thinking that it does back away from here. But it speaks to that the biggest weight, right, at 13, almost 14% of the XLF has moved right to its former all-time high and is struggling at that level.
Gary is saying, and I understand this, he's saying not a double top until you get confirmation. Yeah, that's fine. And there are shows that will tell you after the fact, what just happened. We're trying to be in front of certain things. So, we're saying that formation is setting up for that. I happen to think that's how it's going to manifest itself and reconcile itself. And if I'm wrong, I will come on here next week and say, guess what? That double top was not correct. We blew through on the upside. And, that's the way it goes. But you try to be in front of these things, not, with the rest of the mamalukes to talk about things ex post facto for you Jesuit education people out there.
Well,
Mamalukes.
I mean,
that is no one's bingo card, Guy. Mamalukes.
Yes, we're trying to, anyone. I mean, we're not at least I'm not. I guess I'm not a journalist. I'm not reporting on the facts after they've happened. It's like saying it's not a double top. It's like saying it's not an election win until the person wins, or it's not a World Series win. Yeah, no kidding. This is elemental. Not to sound like contradicting every comment that comes up here, but let's have the comments be sort of thoughtful and practical and relevant versus just sort of obtuse and stating the obvious. Yes, of course, it's not a double top until it's happened, but we can make judgments. You could say, I don't want to bet this one, leave it alone. I do want to bet it short for the double top, or guess what? Bet it for the breakout, or, you go play golf.
For the first person that says what movie the word obtuse was used, I'll give you a shout out. I obviously know, Dan does as well. My sense is Carter will know.
Free water bottle. Free water
bottle.
Free market call water bottle.
Shawshank Redemption.
Carter wins.
Carter wins. He gets a bottle. That's going to get you sent into the hole, Carter. All right, listen, bud, we really appreciate you doing some heavy lifting here with us today on the market call. All right, Guy, let's do a couple things really quickly here. Let's go to the S&P minis, the futures here, because I think this is kind of interesting. We're off about 3.5% from those recent highs here, but it's not the S&P that I'm most focused on when we pull that one up. And we're going to go to the Nasdaq 100 E-mini futures in a second here too. That looks like it's going back to that breakout. Okay?
43.50-ish. Yeah, but yes, that prior high from August of 22.
Yeah, it feels like it. And we have that rising 150-day moving average. Maybe by the time it gets there, they're converging a little bit. And that at that point, someone's going to have to make a decision, right? Because that is the technical level. This one, though, the NASDAQ 100 E-mini futures, this is really interesting to me, Guy, because look at that. The steepness of that uptrend, basically unabated until that move. Now, one of the things I'll just say, and, we've been talking about this, Apple and Microsoft, the way that they sold off after earnings. Now, granted, you could say, for some of you kind of mamalukes, or what do you call them?
Mamalukes.
You could say that, well, the move that they had over the last few months was pretty astounding. The only thing I'm going to say, when we don't have valuation support, when it seems to be a very fuzzy picture on the fundamental front, as far as, Apple has guided down revenues 2 quarters in a row. I mean,
I think this was
okay.
Yeah, 3, but yes, you're right.
So let's look at the technicals, okay? Because Microsoft and Apple, $5.5 trillion in market cap, have already broken their uptrends that have been in place. So when I look at this E-mini future guy, what does this say to you? Because, next week, and I know we talked a lot about NVIDIA, but next week, when this company reports on August 23rd, I mean, it really holds the fate, in my opinion, 100%. Of the NASDAQ.
This entire chart hinges on that report and the subsequent either guidance or price action. Yeah. And again, NVIDIA's you mentioned it yesterday. It's doing it again today. It's having a remarkable bounce off the low we saw intraday yesterday. Yep. I mean, it's pretty significant bounce. I think Morgan Stanley, at me if I'm wrong, but they obviously said this sell-off is a buying opportunity. I think they have a $500 price target. That's great. Maybe they're right. And maybe Chinese are ordering chips ahead of us. I have no idea. This bounce is extraordinary, but they do report next week. And again, at current level, so where's stock trading? Probably about 450 thereabouts, $1 trillion company, probably north of 60 times forward earnings ish. My sense is we're either side of 24, 25 times revenue ish, regardless of what they say. Again, historically, that's a very expensive company in that sector. I mean, there are companies that may deserve that, and maybe NVIDIA is one of them. But, the semi space, the last I look, is still a highly cyclical industry.
I was shocked. We were recording a pod at 9 o'clock. NVIDIA was down on the day. This was yesterday morning. Okay. And from its lows yesterday morning to its highs, okay, just a little bit ago, it's come off about 1%. It rallied about 10%. That is, just do the math, guy. Mm-hmm. It's $100 billion in market cap because a couple brokers said next week it's not going to be, it's going to be fine. And it might be fine. Okay. So for any of you guys who are really interested in this name and the semis, I have Dan Niles on with me. I'm going to record it this afternoon. He's a Satori fund. Dan, in my opinion, is a brilliant tech investor. I've known him for 25 years or so. That's going to drop on OK Computer tomorrow morning in the podcast store. So go follow it there, people. We're going to talk all things Q2 tech earnings and what he sees for the balance of the year. So check that out. Guy, a couple of things. Danny Moses, our pod partner on the tape, came in the office about an hour and a half ago, was all geeked up. And you're going to have to tune into the On the Tape podcast on Friday to see why he's all geeked up. But he said, I got the trade of the day for you, XHB. Okay. And so he just gave me 3 bullet points. That's the best trade idea, isn't it? When you get 3 bullet points in a chart, that sort of thing.
That's Danny Moses.
Yeah. And so I looked at September expiration and I bought some puts on the 83 line, paying a little less than $2 for that or something like that. You see that consolidation there. So that is a Danny Moses special. I've also been legging into some September 34 puts in the XLF guy. Okay, so these are some near dated, okay, near the money, risking what I'm willing to lose, risking about 2% or so of the underlying. I kind of like the risk reward here, especially when we go back to some of that initial conversation. In the summer of 15 or in other periods where we had sharp drops,
everything looked great.
No one expects it, right?
If you go back and look, I mean, you can Google machine yourself, check out your fact check machine, but the move we had from late 14 into the spring of 15 into the summer, market was just sort of doing its thing, unabated, lower left, upper right, making an all-time high, I think 21 something in the S&P 500. Then obviously we fell off a cliff, seemingly out of nowhere. So I'm with you, and it would be fitting. Because yesterday, I think it was yesterday, those 13Fs came out and Buffett initiated in 3 home builders. DHI was one of them. I want to say Toll Brothers or Lennar and NVR Corp. NVR is like a $6,000 stock. So it looks like he didn't buy a lot. He actually, across the board, I think he bought equal amounts in terms of dollar amounts. But it would be interesting that in the short term, he basically would have rung the bell, or that announcement would ring the bell on home builders. Just something to think about.
All right. Last thing before we get out of here, let's take a look at crude oil. We spent some time talking about it last night on Fast Money with Halima Croft.
We got a question about WTI.
Is she the best? She's the best.
Well, RBC Paul Sankey and Halima, I mean, they are the absolute best. Yeah. And she says it all the time. She loves coming on CNBC's Fast Money.
That was really fun. I mean, first of all, she's a brilliant mind. But let's look at this crude chart here really quickly, guy. Got back up to those kind of spread tapering highs in nearly 85 or so in WTI. If we were to draw another line, an uptrend from those lows, okay, in July, we kind of just broke that today. Okay, one day does not make a trend by any means here. Thoughts on crude? We've also seen the dollar come back. The Dixie, it was below 100. Now it's above
103 and a
103
half, right? Yeah. No, I mean, obviously, and you said it last time on the show. So this is your trend line. So this is where, listen, we've been in a downtrend for quite some time. We've had some bounces along the way. I think it's safe to say that all this is one of those bounces. Now, I think you know what camp I'm in. I think crude oil is going to continue to be a story this year into next year. I think Halima believes that as well. However, we're trading the here and now. This is a logical place for it to stop. And if you look at a name like Valero, for example, if we could pull it up real time, that stock went from 104 to 139. It's having an awful day today. So that traded up to sort of resistance levels as well, the same way crude did. So in the short term, crude is pausing here. And I think Doug Cass, who's watching right now, put on a short position in OIH, I think yesterday or earlier today. And that's probably going to prove to be a really good trade in the short term as well, because OIH has gone basically from 245 level in June to 4 or 5 year highs late last week or so. So maybe that's sort of exhausted itself. I don't think it's over, but I understand why you would bring those charts up and say we're due for a pause.
Yeah. Lastly, let's just look at that Dixie. We have a chart there. You see that well-defined downtrend, a series of lower highs here after that really sharp move back to it above the moving average there. I mean, I might be looking to play UUP to the short side. I'm on that one. Guy, last one, and then we're out of here. I promise you. Gold. Let's look at the gold futures here, because this is
hanging on.
Well, hanging on,
thread.
but it's below that uptrend, right? That's been in place since October, and maybe it's the dollar, maybe it's inflation. I mean, you tell me. The inflation readings, is that kind of weighing on the gold trade right here?
Well, it's funny. Global yields going higher, fighting inflation actually works against gold. It's somewhat counterintuitive because if inflation's a problem, you would think that gold would work. The flip side of that is if everybody knows it's a problem and they're trying to combat it with higher rates, gold's going to be under pressure. That's historically has been what's happening. It's happening now. I think, and I think Danny will agree with this as well, and we'll obviously talk on Thursday, I think what's going on with currencies, what's going on with gold market, what's going on potentially in Japan with, I think, some cracks in there, obviously curve control, yield curve control that they've had in place for quite some time, is going to find its way into the gold market. I would understand, though, if you said, you know what, everybody's trying to fight the obvious, gold's going to suffer, and here we are. So I'm still a bull. This chart suggests otherwise.
Yeah, no, I just bring it up because, again, we use that term sort of divergences. Sometimes it makes sense to kind of pick apart some of these things that you think should be happening based on certain, relative performance, things that we've all become accustomed to. And some of them, when they're not happening, it makes sense to kind of keep an eye on. All right, we covered a lot of ground here, guys.
A lot of ground. We went a little over, but that's what we do. Excuse me. I want to thank the great Carter Worth. By the way, that's a pretty cool, the risk reversal thing in the background. Did you do that? Or who did that? Rafus?
I don't know. It just
Jacob.
Popped up. It popped up here.
It looks.
Amanda did it actually.
It looks fantastic.
Yeah, we got a couple other signs coming. We're gonna have a market call sign.
All kinds of stuff
computer sign coming. We're gonna have
stuff.
an on the tape sign coming. We might even have a portrait of Danny Moses. How do you think that would do?
We should auction that off and give the money to
I know
charity.
You never watched the Seinfeld, but there's this very famous picture. Maybe you guys could find it of Kramer. It's like the Kramer. It was like a portrait.
Is that the star of the show?
Well, he's one of the stars. Seinfeld would be the star.
Otherwise, the show Seinfeld.
Otherwise, the show would be called Kramer.
I don't know if
that should have been a spinoff, actually. By the way,
I've never seen, and you can at me all you want on the comments. I've never seen, obviously, flipping through the channels. For example, if the Yankees are playing and if they're not on Yes, and I go to channel 11, that's WPIX.
That's just.
I'll go looking for the Yankees, and sometimes you see like a Seinfeld.
Yeah,
but it's not like I sit there and say, "Oh, this might be fun."
Yankees.
I never found a particular.
Seinfeld's a big Mets fan.
Even more reason not to like him. No, I knew that.
And his sidekick George on the show worked for the Yankees
in real life.
No, on the show.
He worked for the Yankees on the show.
And Steinbrenner. It was really funny. It's a funny bit. You would have actually enjoyed a lot of it. It was back in the 90s when the Yankees, before they won in 96, they were the hapless Yankees. And I know they were doing very well in 94 into that strike year, weren't they, Guy?
they were doing well, and it's a funny. Well, I don't want to get into it, but apparently, because I know this, because one of the worst trades in Yankee history was the Jay Buhner trade.
Yeah.
And apparently they referenced that on one of these Kramer shows, Seinfeld shows.
Kramer shows.
Which I find
that would be mad money. And you're on the fast money.
I'm on the fast money, 5 o'clock. But that's it for Market Call.
Yeah, it is.
Thank you, Carter Worth, for appearing on a Tuesday.
Yeah.
That's typically not
he's going to be back with us on Thursday.
Not tomorrow.
Not tomorrow.
Tomorrow will just be the two of us.
Just the two of us.
Tomorrow we'll be back at 1 o'clock. Today's episode, of course, I want to thank our sponsor, CME Group, where risk meets opportunity. Great commercials with Laird Hamilton and others. And obviously, FactSet, our data provider, financial data and analytics, powered by Tomorrow. I thank you for all the comments, snarky or not. I appreciate them all. But I will tell you, I will come back at you. I'm just saying, because that's what I do. So just, buckle up, people. That's it. We'll talk to you tomorrow.
Thanks, everyone.